Looking at one's mortgage rate compared to 30, 40 years ago is not an apples to apples comparison. You need to also take into account the value of a home relative to one's income. So 30, 40 years ago, when interest rates were high single digits, low double digits, the income to housing ratio was much greater in the sense that one's income was much higher relative to the price of a home. So what they paid up in mortgage rates, they got back the benefit of buying a cheaper home. Whereas today, we have an 8% mortgage rate that is on top of a 40% rise in the average price of a home just over the last 2 years, with a income to home value ratio being the smallest in data going back many decades. So it's that analysis that completes it and shows that housing is extraordinarily unaffordable. In fact, the National Association of Realtors just came out their new affordability index, which shows the most unaffordable housing market, and data going back, I think it was 1989.
Welcome to the Rose Show podcast. Thank you so much for joining us. I have the pleasure of being here with Peter Boockvar. Once again, this is our second meeting from a few months ago. He is the CIO of Bleakley Financial Group, also editor of the Boock Report, and he's a contributor to CNBC quite often. You should watch his clips. They're very insightful. So how are you doing today, Peter?
Great to be here. Thanks for having me on again.
Absolutely. Thanks for being on. So last time we spoke about yields, and you were talking about the chances of the long-term yield, the 10-year in particular, going over 4.5, and it's gone way beyond that. And long-term rates are all headed upwards, and we could be due for a short-term pause, maybe a short-term bottom. So what are your thoughts on what's going on in the world of yields?
Well, I would say prior to mid to late July, there was this assumption that we were entering sort of an all clear phase, and that inflation was moderating and the Fed was going to be nearing the end of its rate increases. And then really beginning late July, we saw this very sharp rise, the beginning of a very sharp rise in long-term interest rates, where the 10-year yield went from about 3.75, touched 5 just the other day, and has since backed off. So I think that took many by surprise. And there's a confluence of events that I think was the reason, and not all of them are for good reason. I think a large part of the sort of the push higher in long-term interest rates was around late July. The Bank of Japan decided to widen again yield curve control, where they had it prior to that late July announcement at 50 basis points above or below zero. They announced that they would tolerate a range of 50 basis points to 1%. So that really, to me, started the acceleration higher, because it wasn't just a rise in US rates, it was a rise in Japanese yields in response to that. And European rates have gone up sharply as well. Then you can throw in, of course, worries about US debts and deficits and all the Treasury supply that's coming our way as another reason for you can blame quantitative tightenings, because all of that supply is not going to be readily absorbed by central banks. Also, you have foreigners that are buying less US bonds. But like I said, the rise in interest rates has been a global event. It's been in Australia and South Korea. You name any country, you've seen a notable rise in interest rates, even as inflation has been topping out. So that tells you that there are other things going on. Now, US growth has hung in there, but Europe is basically in a recession. So rates are not rising in Europe because the economy is good. It's rising for other reasons, to my point of rates rising for not all of good reason.
Absolutely. And the yield curve in the US is becoming less inverted, and it's the worst case scenario with the long-term rates rising. And usually that tends to be an indication of a recession upcoming. What are your thoughts on that occurring? And do you believe a recession is baked in for early to mid 2024?
Well, you point out rightly that the disinversion is happening because long rates are rising, where short rates are pretty much stable because the Fed has said we're going to keep rates here for a while, as opposed to a bullish steepener where the Fed is cutting interest rates and long-term rates are dropping while long-term rates are not to the same extent, or even rising in that scenario. So I think this is now a sort of a yield curve squeeze across the yield curve, and that rates are now rising notably across the board, where first we had mostly the notable rise in short-term interest rates. Now it's being joined by the rise in long-term interest rates, hence the flattening of the curve. Now, we're certainly not in a recession yet, to my surprise, but just because one has not happened yet doesn't mean it's not going to happen. I see a lot of fragility in the economy, and I see the dark clouds continuing to spread, whether that is a clear change in behavior on the part of the U.S. consumer, particularly lows or lower and middle income consumers. We're seeing a squeeze on bank lending. We're seeing obviously a lot of challenges in real estate. We're seeing any small to medium sized business that has floating rate debt that has gotten squeezed because of the sharp rise in interest rates and what that means for their interest expense. I mentioned earlier about a likely recession in Europe, slowdown that's going on in Asia, triggered by certainly a notable slowdown in China. So to me, a recession is inevitable as this very notable rise in interest rates catches more and more households and businesses as debt comes due, whether you're a household that has maybe an adjustable rate mortgage that's comes due, or you're not fully paying off your monthly credit card bills and you're paying a 23% interest rate on the outstanding loan, or you're a business or a real estate owner that has debt coming due. There is an ongoing interest rate reset that is replacing high cost debt with much lower cost debt.
Well said. Agree completely. These higher rates affect everyone, the markets, especially the housing market and everyday life. So it's absolutely doing a tightening of the consumer. I want to go more into the Bank of Japan. You do speak about them often, and it's very important that we talk about them. I don't know if everyone's aware, but Japan is the largest foreign holder of US debt. And what they do with the treasuries as they're buying their bonds, they're getting rid of our stuff and they're moving into their own country, that definitely affects us. They're draining liquidity from the international market. Could you please tell us more about what's going on in Japan and what do you think their motives are? What's their plan in the next 6 to 12 months, and how could it further impact the US with the treasuries and the high supply that we do have with all of our debt?
So going back decades, the BOJ has sort of been the architect of modern day monetary policy of QE and zero rates. And they followed the Europeans into negative rates a few years ago. So what we're seeing now is they are also the last major central bank holdout that is finally responding to the global rise in inflation and the notable rise in inflation, particularly in Japan, where inflation ex food and fuel is running at about 4%, which is double their 2% target. So the BOJ now playing catch up, but still tightening nonetheless, I think is a very big deal, not only for Japan itself, because not only are rates rising because inflation is higher, but Japan is a very indebted nation with debt to GDP of about 250%. Now, they're lucky that they are actually a creditor nation in that they own more assets outside Japan than foreigners own in Japan. But it doesn't take much of a rise in interest rates to have an outsized impact on the finances of the Japanese government. Also, as you state, them being the largest foreign holder of US treasuries, if all of a sudden Japanese bonds become more attractive to Japanese investors, they will repatriate that money back home and own JGBs instead of US treasuries and not have to deal with any currency risk or having to deal with any hedging that might be needed. So it is an important thing to watch, particularly ahead of another BOJ meeting at the end of October. There's chatter that maybe they'll tweak yield curve control again and maybe just scrap it because it's not an easy thing to manage. They already own half the JGB market. Their balance sheet is more than 100% of their economy. They need to get out of negative interest rates at some point. They need to deal with the weakening yen, which is trading at multi-year lows at 150. But there are risks to this, not just again to the finances of the Japanese government, but it is very influential in the direction of global interest rates, particularly Europe and the US.
Well said. I agree completely. And thank you for enlightening us about the history in the Bank of Japan. And as we all know, the US is a net debtor. So we are not a creditor. We haven't been for quite some time. So very important to watch all of those issues. Now, do you think the bond market is doing the job for the Fed, and that the Fed may pause and may stop at this level, especially with what's going on with the housing market?
There's no doubt that the rise in long-term interest rates is further tightening policy, lessening the need for the Fed to raise short-term interest rates again. Since the July Fed rate hike, which was their last rate hike at 25 basis points, look at the average 30-year mortgage rate, which trades off the 10-year, it's up another 100 basis points. That is an enormous amount of tightening on the most interest rate sensitive part of the economy, that being housing. Now, while the market is doing the tightening for them, it certainly has been pushed by central banks into doing that tightening. As I mentioned, the BOJ is very responsible for the rise in the 10-year yields here. QT is very influential on the rise in long-term interest rates. So the market, yes, is doing the job, but definitely pushed a little bit by central banks into doing so.
Yes. Do you think that the Fed may actually be at a point, because of all the foregoing, that they may need to cut rates and go back to a lower rates?
At some point next year, they'll start debating that because I think that the cumulative impact of all these rate hikes continue to have its impact. And but there'll be a really difficult question of to what extent, because the last thing that the Fed wants to do is give up what they've done so easily and see any real reacceleration in inflation. That's why if or when they start to cut interest rates, it's going to be very gingerly, and it's not going to be by much. So right now, the Fed funds rate at a range of 5.25, 5.5. I mean, even if the Fed cut down to 4, 4 is still well above 0 that we had for 15 years, essentially, outside of a short period of time in the 15 years prior to 2022. So that would still be a very elevated level of interest rates, albeit still below the peak that we're currently sitting at.
Absolutely. Now, we've spoken before, I think last time we met, about this, and I did hear you speak about this. Well, the real estate market is probably the most unaffordable in over 40 years. And now some people say, oh, but the rates aren't as high as the 80s. But actually, it's a different dynamic now. Even though the rates aren't as high, the actual debt to the asset, the actual debt number is much higher portion of the portfolio. Could you tell us more about that dynamic?
Yeah, so it's looking at one's mortgage rate compared to 30, 40 years ago is not an apples to apples comparison. You need to also take into account the value of a home relative to one's income. So 30, 40 years ago, when interest rates were high single digits, low double digits, the income to housing ratio was much greater, in the sense that one's income was much higher relative to the price of a home. So what they paid up in mortgage rates, they got back the benefit of buying a cheaper home. Whereas today, we have an 8% mortgage rate that is on top of a 40% rise in the average price of a home just over the last 2 years, with a income to home value ratio being the smallest in data going back many decades. So it's that analysis that completes it and shows that housing is extraordinarily unaffordable. In fact, the National Association of Realtors just came out their new affordability index, which shows the most unaffordable housing market, and data going back, I think it was 1989,
Wow.
that they have data on.
Wow. Yeah, absolutely agree. I mean, home sales are down and home prices are still up in many areas. In our area, I mean, the New York metro area, in my market, home prices are still elevated. So it's, I think the Fed trapped people in their homes. And I think you've said that before as well with these low rates. But then my concern is what happens once we hit this inevitable recession. And, you know, unemployment usually rises during the recession, and sometimes even afterwards. It can be lagging as the jobless recoveries we've had in the past few recessions. So at that point, when people lose their jobs, they're going to be forced to sell their homes, and we could see a flooding of the real estate market all at once. So a lot of potential headwinds there, Peter.
Yeah, the housing market has been turned upside down. I mean, the Fed has just really destroyed the normal cycle of the housing market, going back to the early 2000s when they stoked that housing bubble. They have really damaged the American dream for a first-time home buyer or wannabe home buyer in being able to affordably own a home. And now they've done even more damage when they were doing QE and buying an enormous amount of mortgage-backed securities and resulting in this major housing inflation. And to your point, yes, what would eventually bring more supply onto the housing market that is supply starved will unfortunately be a higher unemployment rate, where people are going to have to downsize and sell their home and rent instead, which renting is no cheap thing either after the notable rise in rents over the past couple of years.
Absolutely. Well said. It's an unfortunate thing that has occurred now. You know, higher rates, higher cost of money, higher cost of debt and capital, and there's a complete re-rate of risk. I guess we've all removed those beer goggles, right? I love that quote that you had from a while ago. But yeah,
no
it's
question.
Absolutely. So we have massive debt. The government is spending to no end. And like you mentioned earlier, our debt to GDP is significant. I think we're over 120%. Now debt is now 33 trillion plus, interest expense over $1 trillion a year. And there's no end to that in sight. What are your thoughts on what's going on with that? Will it end? What's going on? Why are they spending to the point of just, you know, how are they going to be repaying it? The tax receipts are less than half of what they're spending.
So the debt will never get repaid. It's just managing the refinancing of it. The U.S. government just finished their fiscal year, ended 2023 on September 30th. The budget deficit as a percent of GDP came in at 6.2%. And just to provide context to that, usually the budget deficit is the widest or bottoms at the depths of a recession. And in an economic expansion, it shrinks as tax receipts rise and spending falls as a percent of GDP. And whereas in a downturn, tax receipts falter and the government typically spends more money to help stimulate the economy. So in the early 80s recession, the early 90s recession, the budget deficit as a percent of GDP got to about 5%. At the depths of the 2008 recession, it got to about 10%. So here we are at 6.2% before a recession has even begun, with unemployment below 4%. And you think that in the next recession, this deficit is going to go north of 10%, which means that the U.S. Treasury is going to be selling an enormous amount of treasuries to raise money on top of what already right now is an enormous amount of Treasury borrowing, where the budget deficit is about $2 trillion in absolute dollars. And as I mentioned, 6.2% as a percent of nominal GDP. So these are extraordinary numbers. And to separate out that government spending, we have discretionary spending and we have non-discretionary spending, where non-discretionary spending is, as we know, Social Security, Medicare, and so on, that is just on autopilot. Unfortunately, that will not get any changes to these programs or any slowdown in the discretionary part until there is a crisis. Now, you'd think that the level of interest rates would cause a timeout in Washington in terms of the level of spending, but there's been no discussion of that whatsoever.
Exactly. I think it is a huge portion of the GDP. Like you said, 6.2, 6.3%, the deficit is of the GDP. And in my opinion, and I've been reading about this as well in my research, and it appears to be the worst GDP growth when you exclude the government spending, which is now about 37% of GDP. And it's no surprise that GDP is higher. It appears that there's a crowding out effect and that the private sector is the one that will suffer, and they could be already in a recession. Do you think that the private sector is in a recession disguised by this bloated deficit spending?
Well, parts of it. I mean, U.S. manufacturing has been in a recession for
Absolutely.
about a year and a half.
Mm-hmm.
There's some signs maybe that we're bottoming out in terms of a lot of the inventory destocking maybe is close to running its course. If you're a low or middle income consumer, you're feeling a recessionary type of environment as you're dramatically changing your spending habits. If you're a real estate broker who sells existing homes, well, your business is basically in a recession. And then on the flip side, if you're in the new construction market, you're doing okay if you have access to capital and you're one of the bigger home builders. So parts of the economy are in a recession and parts are not. I mean, we know that higher end spenders, income earners are spending. Leisure and hospitality and spending on restaurants has done very well. As I mentioned, home builders are doing well. Capital spending is more mixed. And yes, if you are a beneficiary of a lot of the government programs like the CHIPS Act and the Inflation Reduction Act, and that's giving out free money and tax credits for anything renewable, well, you're doing okay. If you're trying to build an EV battery plant in Kansas and you just got government tax incentives, you're doing okay. The question is what happens after a lot of these things get built, and will the economics warrant a lot of the building? We'll have to see.
We will have to see. And well said, there's pockets. It's just like inflation. There's going to be sticky pockets. There's definitely recession in many areas of the economy, not all. And I remember last time we met, you made a great point that real estate is actually like in a stagflationary environment. Because of all the people, the labor on the homes. When you don't have this much turnover in the markets, you have less need for all these other services related to housing. So it affects so many other variables as well. So, my concern is who will buy this debt? These treasuries, like we spoke earlier about the Bank of Japan, buying their own bonds and selling off the foreign debt. Who will? Could demand increase on treasuries due to the upcoming recession and possible eventual the Fed rate cuts?
Well, there'll always be buyers of treasuries. It's just a matter of what that clearing price is. And at least what we've seen over the past couple of months with long-term treasuries is that clearing price is much higher in yield, lower in price. So now, to your point about crowding out, it is a very important thing right now, because when you think about very attractive treasury rates where they are, everyone is like, yeah, I'm going to buy treasuries. I'm going to put my money in a money market fund and look at the yields I'm getting. Well, every dollar that goes into a T-bill or a money market fund, treasury money market fund, that's $1 that's coming out of the private sector. So there's no question that there is a crowding out. It's making the cost of capital for the private sector higher, and certainly from the commercial banking industry, it's making the access to credit that much more difficult as well, as people that have had money in deposits at the bank are now taking their money out of the bank and putting it in a 5% plus money market fund, as opposed to getting, 0.5% at a bank, or even maybe 3 to 4 in a CD, but they have to lock up their money for that.
Exactly. Well said. Well, guilty. I'm also utilizing T-bills myself as well as money
Yeah.
market, right? I mean, it's safe when you have risk-free rates over 5.5%. And then you look at the equity risk premium in the markets, in the equity market, especially the big cap tech, you're like, I need to be compensated for taking on this risk. A nice 5.5% risk-free isn't so bad. So, why do too much, So great points there, Peter. Inflation is entrenched in many areas of our economy. And I think they'll probably remain sticky going forward. We had that Michigan consumer sentiment, I think it was last week, October 13th, I think it was, and it fell again. And inflation expectations went up to, I believe, 3.8% from the 3.2% the previous month. And, it's just overall general theme. We all know costs are higher. We have higher prices across the board, new fees as well, overall lower growth. And manufacturing, like you said, has been a recession. I agree completely. And, the dollar strength is another thing we're going to talk about, is hurting foreign sales for companies. And, and unemployment is something that rises, like I said earlier, later on in the recession, not before the recession. So with all the foregoing, and the shrinking of the money growth as well, we have that going on because we have lower supply and demand in lending, like all the issues we discussed. Do you think we could be headed in a stagflationary environment?
Yeah, so we mentioned housing. Residential real estate is in your textbook stagflationary type of environment, where you have the pace of transactions near the lowest level in decades. If you look at the mortgage bankers data, mortgage applications to buy a home is the lowest since 1995, and prices are very high. So that's textbook stagflation. I think the rest of the economy, it'll sort of be stagflationary light, in that I think growth will settle out at a pretty low pace, while inflation is going to remain elevated relative to its pre-COVID levels of 1 to 2%. I think 3 to 4% is going to be, for a period of time, a new normal level of inflation, and combine that with more modest economic growth. Now, Q3 growth is going to be probably in the 4% range, and that's getting a lot of people to scratch their heads. But I am doubtful that that is something sustainable, and sort of can be sort of the last big breath of the economy at these levels of growth.
Well said. So, and then we also have to add in the heartbreaking geopolitical issues that are going on right now, just adding more to the fear and uncertainty. And like you mentioned earlier, excellent points, is how the debt usually rises during times of war, or, these type of the pandemic. So with the potentiality of us getting involved in the geopolitical issues, our debt can go up significantly, even more so in the next year or so. So you add that. And then do you think that with this rising fear and uncertainty, people may go to the flight to safety with these bonds and these treasuries? Could that be the catalyst to bring everyone back to buying the treasuries, and domestically we're, building up our, helping pay down on the debt?
Well, I think right now treasuries are safety, but only short-term treasuries are. I don't think the 10-year yield or the 10-year treasury note is going to prove to be safety, because of the price risk. If you look at even the 10-year yield, after backing off from the 5% level that it touched, it's still above where it was the weekend before the attacks on Israel. So it was a safety trade only for a couple of days, and then it was not. The interesting thing about it potentially being a safety trade again, if the economy goes in to recession, where historically it was. Historically, you want to buy bonds when you're expecting, treasury bonds when you're expecting an economic downturn. But what happens if this time it doesn't work to that playbook, and only short-term treasuries benefit from that? Because long-term treasuries, what happens if we go into recession and the budget deficit skyrockets under that scenario? Because spending goes up and tax receipts falter, and the U.S. government has to sell even more bonds, and there's more supply coming our way. That makes it more difficult to get price increases in the long end of the bond market, because it's just too much to absorb. So you can get a recession and a rise in long-term interest rates. That would not be a fun scenario at all, but I can't discount that as being a possible outcome.
You're very wise, Peter. Thank you for sharing that potential outcome that we do not want. But just like last time we met, when you said watch for those long-term rates to go up higher, and they did go exactly as you said in this range. So that's definitely something we need to watch as well. So let's talk about markets. I know equities are everyone's favorite topic, and we both agree that the multiples look extended, especially with these higher rates. And so what are your thoughts when you look at the market and what you're seeing across the different sectors, and what's seeming to be more attractive to you versus less attractive?
Well, we really have two markets. We have big cap tech as one market, and the other market is everything else. If you look at the Russell 2000 this week, before a bounce, it closed at its lowest level in about 3 years, while the big cap tech stocks while they're off their highs, are relatively near their highs. So it's a very bifurcated situation. You have growthy stuff still well outperforming value stocks. So it really depends on where you look in terms of defining the market. And the question is whether those big cap tech stocks are masking a large amount of underlying weakness that will eventually catch up to those big names, or at some point that weakness catches up and rebounds and starts to trade well because of the large cap stocks trading well. I think it'll be the former rather than the latter, because when you think about these big cap tech stocks like Microsoft and Google and Meta, how great they are and how fortress balance sheets that they have, their customers are still small and medium-sized businesses, many of which, obviously they have large customers too, but their business is still predicated on the health of the overall economy. They don't breathe separate economic air. They breathe the same economic air as the rest of us.
Well said. Absolutely. And smaller businesses are definitely more sensitive to these rate hikes and these higher costs. So it could definitely impact those big, I guess they call it the big seven, I don't know, magnificent seven, whatever they are. But yes, like you said, it's a bifurcated market. You have those big tech, and then you have everything else. So let's talk about the everything else. And I particularly have a fondness for the international markets, emerging markets, and other countries. Are there any ones in particular that you like that you're looking at?
So I'm very bullish on emerging Asian markets, like Singapore and Vietnam. Indonesia is attractive. I'm even bullish on the developed market of Japan, which we're long stocks there. India is a very exciting story.
Yes.
And even with China, China with all of its challenges, with all of its battles with the US, there is a middle class that's going to grow sharply there. I've seen stats that, can't remember who the company was, but I've seen other stats too, that the size of the Chinese middle class is going to go from 400 million people to 700 million people over the next 5 years. So this growing middle class, this growing wealth in Asia makes it a very exciting emerging market story. And you're talking about stock markets that have dramatically underperformed US markets over the past 10, 15 years. So that's exciting. And not just on the equity side, but also on the bond side. We like emerging market local currency bonds, particularly in Asia, that I think you will get the benefit of an eventual weakness in the dollar relative to these countries, in addition to some pretty good yields right now.
Agree. I'm also looking over there. I've been doing some research about China, and yeah, they've been going for quite some time into more of a service economy, and they've been shifting. So there's a rise in that middle class that's forming, and so they're going to be wanting and needing services and just basic services that we take for granted here in the United States, but it's growing over there. So definitely lots of opportunities within the big country of China. Actually had someone recently on, an old friend, but he's a filmmaker, and he was talking about China and how the movie theaters, I know there's a lot of censorship, but they're growing. It's like growing significantly. People are getting excited to be able to go out to the movie theater. Well, we've had that since the beginning of time here in the States, but these little luxuries, I guess you call it, are just starting to really open up over there. So it's very fascinating stuff to learn about. So thanks for that.
Yeah, I mean, domestic travel in China is above its 2019 levels. It's the international side that has a lot
leisure.
to catch up, but it's going to catch up. The Chinese tourist spent $250 billion in 2019 outside of China, and we're not yet close to that number. So there is a lot of catch up, and that Chinese tourist is going to be out there and spending in the coming years as they try to revert back to their pre-COVID lives again.
Absolutely. Well said. The travel and leisure sector over there. Absolutely. There's just a lot of that going on. So we definitely something to watch. Besides international markets and emerging markets, the asset classes, let's talk about gold. Everyone's talking about gold. It's been talked about, and this was the flight to, in stagflationary times back in the 70s and 80s. What are your thoughts on gold? Do you think it's going to go past 2,000? And some people are even saying 4,000 and higher. What are your thoughts? Are you bullish on gold?
I am bullish on gold. I've been bullish on gold for a while. This is nothing new for me. I think that gold is going much higher. I think gold has put in a stellar performance over the past year and a half plus since the beginning of 2022 in the face of the fastest rise in interest rates in generations and in a very strong dollar. So to be able to trade as well as it has in the face of that, I think says a lot about its natural underlying demand, with a lot of that coming from the world's central banks. And that certainly was facilitated too by what the EU and the US did after Russia invaded Ukraine, where we basically froze half of Russia's central bank reserves. It made owning gold for any central bank that much more attractive because no one was going to confiscate your gold holdings. And that central bank buying continues on. So I expect much higher prices in gold. I think once the Fed is formally done raising interest rates, I think that will end up being a boost. I think the U.S. exploiting debts and deficits is going to matter for the dollar negatively at some point. And even with the recent dollar rally, it's still well below its October 2022 recent peak. I mean, the dollar strength has really proven to be just strictly an interest rate / central bank differential thing. It hasn't really been much more. And I'm very bullish on metals. I'm also bullish on other commodities like energy, oil and gas stocks, uranium, copper. And I think commodities are, while they're certainly going to be impacted by the vagaries of the economy, I do think that there's an underlying supply challenge for many of these that are going to lead to higher prices. I mean, we've seen even this year and last year, the safety trade has been gold and energy stocks and short-term treasuries. That's been the safety trade, and I can expect that to continue.
Agree completely. I've been really bullish on commodities and believe we're in a secular bull market for commodities, and there's a high demand of real assets. So yeah, oil, energy, uranium, agree. Energy is the key. We need energy to survive. And then, another one of interest is lithium. I find that interesting as well. Very volatile, but interesting. Now, what's this correlation? Usually we always study in economics Commodities and the dollar are inversely related, right? Well, we have the dollar up, we have rates up, obviously they work together, and gold up as well. So what's going on? Do you think one of them is going to turn another way or what?
Well, that's been the most interesting thing here is we've seen this dramatic rise in real rates at the same time as we've seen a rise in gold. If you look back over the last 2 years so when the Fed started raising interest rates, you look at the real 5-year yield, it's gone from minus 200 basis points to plus 200 basis point, 250 basis points today. And in the face of that dramatic move, gold is still up. So, like I said, it
Yes.
tells you that there's this large underlying bid for physical gold that is keeping prices where they are and having it trade as well as it is, and just a stone's throw from record highs.
Absolutely agree. Now, with your gold, I actually did a tweet about this because there's a lot of discussion about ways to buy gold. Are you one that's bullish on the physical asset of gold? Do you like the ETFs, the futures, the miners? How do you like to have your gold?
So for clients, we own a combination of physically backed ETFs, like PHYS for gold, for example. And we do own some miners, both through ETFs and also individual companies. So I think it's good to have a combination. We tilt more to the physical just because the mining business is so difficult and mining stocks for the last few decades have been so disappointing relative to the price of the underlying gold and silver price. Now, at some point that will change and gold miners will get appreciation from the markets again, particularly when gold miners today can sell gold for $1,950 an ounce after this recent rally, and their margins are going to expand even further. I think people at some point will wake up to the profitability, outsized profitability of this sector in this upcycle. But I still think it's good to own physical where you don't have to deal with the terrible mining business that it is.
Exactly. And there's margins compressed with all these businesses as well as the miners. So absolutely. And diversification is key. Like you said, have a mix of different things. And there's an ETF for everything nowadays, right? I think you can buy almost anything through ETFs. And I like that. It's a great liquid vehicles. And that's key. It's liquidity is always very important. So well said, Peter. Thank you so much. And like you said, that going international, there's a lot of stagnation that's going on. We know in Europe, in the Eurozone, there's stagflation in many of the different countries there. And US is headed for, who knows, definitely a recession, but a lot of stagnation. So these international markets are probably going to have, in my opinion, the most growth going forward the next few years.
Yeah, and people have to keep in mind when you look at, let's take Europe, for example.
Yeah.
You look at the FTSE 100 in the UK, a lot of that index is commodity based. It's BHP, it's Shell, it's BP. So that market sort of trades off where the pound is going and where these commodities go. If you look at the French CAC, they're heavily influenced by fashion companies like LVMH, Kering, for example, that owns Gucci. If you look at Germany, Germany is very industrial and manufacturing based. So Siemens, for example, BMW, Mercedes, these are all global companies that have the same geographic exposure that Toyota might in Japan or Ford and GM may have in the US. So it's important when you invest internationally to understand that there are always opportunities in these international markets to find, but for whatever reason, stocks that trade outside the US tend to trade at a cheaper multiple than in the US, even if they're their same line of business, even if they have similar sort of breakdowns in terms of geographies and where they sell to.
You are a wealth of information, Peter. Respect you so much. Thank you so much for sharing that. Such an excellent point. You have to always look under the hood and always look at those multiples. You can get greater value outside of the States. I think it's everyone just, the US equities are just so sexy. I guess the New York Stock Exchange, everyone goes crazy for it. And the multiples are so extended. So absolutely well said. Thank you so much. Now, I want to talk about the digital gold, Bitcoin. What are your thoughts on digital assets and mainly Bitcoin? It's been holding firm. It's been going up. I think it hit like 35,000 overnight. It's in that high range of 33, 34. It's definitely uncorrelated and broken away from the markets. Could be a global reserve asset. Your thoughts?
Well, I sympathize with Bitcoin bulls because they're bullish on Bitcoin for the same reasons that I'm bullish on gold and silver. You're talking about an asset where the growth of it in terms of quantity is very slow. Obviously, there's a limit to Bitcoin, but there's still mining growth of about 1 to 2%, similar to the production growth rate for gold. So it is a scarce asset that can't be printed by a central bank. So I understand why people own Bitcoin. I'd rather express it through gold. Bitcoin is certainly getting a lift here from the growing likelihood of the prospect of ETFs that will own Bitcoin. So all power to those that are bullish. I don't really care for it to hold as an asset. Again, I can express my macro views through other things rather than Bitcoin. Certainly, that has not been to my benefit when it was, in pennies 15 years ago. But it is what it is, and I just think people should have eyes wide open. But it's definitely benefiting from the ETFs that will have to own it, and it'll be a great trading vehicle for people.
Absolutely. Well said. Thank you. Now, you said silver too. So I want to go into silver. We talked about gold. How bullish are you to silver compared to gold? Do you think it may be able to run more, have potential for more growth, or is gold just the standard?
Well, gold certainly is, but silver is a very unique asset as well. And if this gold bull market really gets its legs, silver is going to even run even faster. Leverage play on gold. But silver is interesting because half the demand for silver is industrial uses. And one of the main drivers right now for silver in an industrial use is solar panels. And the world is going renewable, as we know, and a lot of solar farms are getting built, and each panel needs some silver. Then you also have obviously jewelry demand, tableware demand, then investment demand. But silver is unique, and it's down 50% from its highs, and I find it extremely attractive and expect it to not only test but exceed at some point its record highs that we saw in 1980 and we saw again in 2011.
Absolutely. Definitely agree on that one. Now, we talked about the finite supply briefly of Bitcoin and gold with the same regard as something that can't be printed. And it has a very slow growth rate, if that much at all, with the mining of gold. So let's go back to why, and that is central banks money printing. Peter, do you believe that with everything we just discussed, and mainly with this rising debt that we have, and the government with no end in sight reducing this spending of debt and accruing more debt, do you think at some point they're going to be printing more money and have to go back to a QE?
So it is a great question, and it's something that everyone should think about in light of these deficits. And it almost seems that they'll have no choice at some point to at least stop QT and then pivot to QE. Now, the dynamic, if it comes to bear, is not necessarily to goose the economy, but just to absorb the enormous amount of Treasury supply that is not being absorbed fully by the private sector. And it could happen in an uncontrollable rise in long-term interest rates, just as the Bank of England stepped in and reversed QT temporarily when we had this liability-driven investment blow up, and we saw a spike in long-term gilt yields. So you could get a circumstance where the Fed is forced to step in and tamp down on any uncontrollable rise in long-term interest rates. I fear that is a growing likelihood. Trying to figure out when that will be is tough, but it's not something you can rule out for sure.
Agree completely. And that is my concern as well. It's that further debasement of the fiat currency, which is why assets, real assets such as gold, silver, and for some Bitcoin, have a very high value, especially during these times. Thank you so much. You're amazing. I really appreciate you being on the show. I respect
Thanks
you
for
so
having me.
much. Absolutely. Please tell our audience how they can follow you and read your amazing book report.
So I've shifted it to Substack. So you can go
Oh, cool.
peterboockvar.substack and try it out or subscribe if you like it. And our wealth management website is bleakley.com if you want to learn about that at all.
Absolutely. Well, I'll be linking all that in the description. Thank you so much. I look forward to meeting up with you again. Hopefully,
Yeah, same here.
hopefully long-term yields aren't that much higher than where we are now.
Yeah,
And those
that would be
scenarios don't come to fruition. So thank
great.
you so much.
Yep, thank you.